Hi, my name is Cody Charnell. I'm a multifamily real estate broker here in Long Beach, California. And today we're going to talk about 4 unit properties. So one of the most common questions that I get from people who may not have invested before is, what would it take to buy a 4 unit property in Long Beach? And it's a great question. A 4 unit building is a great size building to get started with. I mean, you can buy 4 unit buildings with 25% on conventional financing. It's 30-year fixed rate. And the lender will count some of the income that the building generates in rent, and they'll count that towards what you make at your job, so you can qualify for a little bit bigger loan. So what I want to do today is give you a snapshot of, what an average 4 unit looks like in today's market. September 2021. Keep in mind that these numbers are going to change as time goes on. It's just how it works. Interest rates change, rents change, properties appreciate. But so let's get into it. So essentially what I've done is I've pulled a list of all the closed sales from our MLS. So these are all closed 4 unit sales, which happened between January and September of 2021. They're all in Long Beach. And as you can see, there's about 80 sales that have happened so far this year, with an average sale price of 1.267, median sale price of 1.215, which is great. So now we know our average sale price, but within Long Beach, there are a lot of different neighborhoods and the buildings will trade at different income metrics. And I'll go into the detail a little bit on that later in the video. But if you'd like more detail on gross rent multiplier, cap rate, different income metrics, I'll be doing a video about that at a later date. So I wanted to pick a building that was about the average or median sale price, but I also wanted to pick a building that was about the average market gross rent multiplier, or matched about the average income metrics for the area. So this is a market study which we publish quarterly as a company. Essentially, we analyze every closed sale that's happened in our market area. You can see some of the cities here, which we cover. And we'll come up with a couple different metrics. GRM stands for gross rent multiplier. That's my favorite metric to use. We also have cap rate here. And what you can do is for each of these individual cities, you can click to drop down and it'll open up different neighborhoods and submarkets within Long Beach. So I decided to choose a property in the East Circle area. There were 19 sales with an average gross rent multiplier of 5.7. With those numbers in mind, with our average sale price and our just about average gross rent multiplier, I decided to choose this property. This property is priced, well, it was listed for 1.225. It ended up selling for 1.210. The property is 3,300 square feet on a 4,200 square foot lot, approximately 1928 construction. All 4 units they're saying 2-bed, 1-bath, but in reality, they're 1-bed, 1-bath plus a den, which most tenants will use as a second bedroom. 830 square feet each. And there are 4 garages on site and a laundry room. And as you can see, the actual rents down here are $1,600 per unit. And they're saying the market rents are $7,400, which works out to, I think, $1,895 per unit. I think you can actually do a bit better than that. I think you can get $1,995 for those units, plus an additional $100 per garage. Plus you'll get some income from laundry if you install coin-operated laundry machines. So let's see what the numbers look like on this building. All right, so this is a spreadsheet that we use to analyze properties. It's called a pro forma. And if anyone's interested in the pro forma or the market study, feel free to shoot me a message. I'll add you to the email list. So you get those market studies quarterly, and you can use this spreadsheet to analyze your own properties. So what we've done, so we have a property purchase price of 1.210. We have all of our building info. On the inputs tab here, we have our current rents and our estimated market rents. We also have garage income down here, so 4 garages at $100 per month. And I mentioned earlier that with 4-unit buildings, you're looking at residential financing usually. So you can do 25% down. It's 30-year fixed rate. And that interest rate today is about 3.6%. So if we were to purchase this property with 25% down, that's about 302 down plus closing costs. We're looking at about 326,000 in total out-of-pocket cost to purchase this building. It's priced at 15.76 times gross based on the current income. But as we've talked about, there's the ability to raise rents and get it to operate much better. So if you were to raise the rents all the way up to market, you can get this building to operate at 12.03 times gross, which is great. It's a lot better than the market average that we saw on our market study. So if we put 25% down on this building, we have our proposed financing here, which gives us our monthly payment. We also have operating expenses, which are just estimates based on what we see in the market. And in this section, our annual operating forecast, we have our gross rents, less a vacancy allowance, less our expenses, and less our debt service, and it spits out a cash flow number. So if we were to put 25% down on this building, it would actually be negatively cash flowing $5,100 per year. At a gross rent multiplier of 15.76, you start to understand, okay, so if I'm buying in a neighborhood where properties are priced at 15.76 times gross on current income, and I want to put 25% down, I'm probably going to be negatively cash flowing at the beginning. So I have a couple options. I can either buy with that 25% down with the intent of raising rents to get the property to cash flow. And once this property is at market rents, it should cash flow about $15,000 per year, which is great. Or I can put a little bit more money down. And in order to get this building to cash flow based on current income, or at least break even, I need about 33% down, which works out to $399 down plus closing costs. So we're looking at about $423 out of pocket. And by putting that much more down, I'll break even based on the current rents, which are below market. And I'll cash flow a little bit more once I get the building up to market rents, which is great. And if we look down here, so this bottom section is the combined returns. So cash flows, it's important, but it's not the only number to focus on. Really, when you're building a portfolio of real estate, you want to focus on 4 elements of return, which combined give you your total return on equity. So first element is appreciation, which is big in our market. Because you're buying this building with financing from the bank, and the bank doesn't get to keep any of that appreciation, you're essentially using leverage to buy this. So in the first year, we're going to assume that the property appreciates at a rate of 5%, which equates to $60,000 in increased equity in this property for you, which is 14.3% return based on your down payment and closing costs. Cash flow works out to $20,530 if you're able to get all of the rents up to market in that first year. Your tax shelter benefits, so you get to depreciate the value of the structure, and then you're paying down the principal on your loan. So equity buildup through amortization. So each time you make a mortgage payment, part of that payment goes towards interest, part goes towards principal, which is essentially back in your pocket. So in the first year, your $400,000 investment is making about $101,000, which is not bad. So again, I just want to stress, this is just the average deal in our market area, and the numbers are constantly changing. So, you can find buildings with a little bit better income metrics where you can put less money down and still break even. In order to do that, you're probably going to sacrifice either a little bit of area quality or building quality. Also, you can buy buildings at a lower price point. So, if you're looking at that $420,000 down payment, there's ways to get in the market for a lot less money. You can do FHA financing, which is pretty hard to do on 3 and 4 unit properties right now because of something called a self-sufficiency test. But you can use FHA all day long on duplexes, or you can just focus on, 4 unit buildings or 3 unit buildings at a lower price point. Anyway, I hope that was helpful. If you have any questions or comments, feel free to leave them down below, or if you have a request for a future video topic, I'd love to hear it. Again, my name is Cody Charnell. I'm a multifamily real estate broker here in Long Beach, California. Happy investing.